Good morning. I am Avnish Jain and I will take you through this outlook for the debt markets. Let me start with the geopolitical situation in the world. Geopolitical situation remains fluid. The war in Ukraine continues for last 1.5 years without any respite. Despite that, markets have veered away from the risks of war and markets have actually rallied a lot in the last 1 year. If we look at US markets, the narratives have changed across the world in this year. Early part of 2023, the narrative was of recession and rate cut starting end of 2023. This has changed swiftly in the last few months as growth beat expectations, remained solid, and rate markets reversed the earlier drop we had seen in the early part of the year. Now the narrative seems to be higher rates for longer. The US Federal Reserve also has become data dependent. If you look at last 1.5 years, rates in US have gone up by almost 5.25 percentage points to 5.5%. This is the steepest increase that has happened in last 40 years. So clearly, the impact of rates in the market is still being felt. One reason could be that because of loose fiscal policies since the pandemic, the consumer spending remains strong and the effect of rate hikes has been diminished to a large extent. But it is expected as the rate hikes work their way through in the economy, US economy, it should slowly bring down inflation as well as growth. And one could avoid recession altogether. And the current narrative is of a soft landing scenario. From an inflation perspective, things are much better. Though in Europe, the inflation is still high in the range of 6 to 8%. US inflation has dropped to 3.2% in the last reading, but it still remains high from the Fed standard of 2%. The Fed is obviously looking at data and they want the inflation rate to be at 2% in the medium term. To that extent, Fed is not indicating any timeline for rate easing cycle as they continue with their policy of higher rates for longer and continuing to see the incoming data on the inflation prints as well as growth data. In that scenario, overall rates have reversed in the last 2 to 3 months. If we look at US rates, US 10-year, which was around 3.5% about 2 months back, is now over 4% at 4.20. It is one of the highest rates we have seen in last 2 years. So clearly, rate market is expecting there is no recession expectation and a soft landing scenario is very much a high probability event. The markets are not expecting rate cycle to be reversed anytime soon, depending on one or two factors. One is that now the expectation of recession is gone to a large extent, and the new narrative is of a soft landing scenario. To that extent, growth may not drop precipitously to very low levels, which will pull down equity markets and other asset markets. Second is inflation may remain slightly on the higher side, that is plus 2% for some time. This may force Fed to remain on hold for longer till they see a trajectory of inflation coming down to below 2% on a consistent basis. In this scenario, the rate cut cycle or the rate easing cycle, which was expected to start by the end of 2023, is now expected to start somewhere mid-2024. So there is a drop or pushing back of rate easing cycle into 2024, and markets have accordingly adjusted their rate expectations in the markets, and we have seen a sharp rise in rates across the curve. Coming to India, situation is much more rosy, one would say, and a perfect Goldilocks situation, if we may put it. Growth remains strong and resilient, and despite a rate increase of almost 250 basis by RBI in the last 1.5 years, markets continue to benefit from pandemic level spending as well as pent-up demand in the past 1 year. The growth in the economy has been strong and consistent. If you look at the latest release of data of first quarter of FY24, it came at 7.8%, and expectations and forecast is for whole year growth of 6.5%. This will make India one of the fastest growing economy in the world. On the inflation front, things did go well in the first quarter of FY24. Inflation was below 5%, which was well within RBI's target. Unfortunately, due to price pressures on food prices, we saw inflation jump to 7.4% in August. And with food prices remaining high and erratic monsoon, it is expected that food inflation will remain on the higher side for this quarter, which is August and September as well. However, the Kharif crop is expected to hit markets by mid-September and end September. And that would mean that food prices, which were very high, will come down. And obviously, already there is a trend of food prices coming down, especially when we saw tomatoes at 150 plus. They are now down to below 50 rupees. So there is a perceptible change in prices, not only from arrival of crops, but also several government measures taken in the past 1 month to alleviate the food price pressure. Overall, inflation expectations are not really going up that much. If you look at core inflation, which RBI also tracks, it was at 4.9%, which was slightly lower than a previous reading of 5%. In the last policy, RBI increased CRR by the way of incremental CRR by 10 percentage points to manage liquidity, because now they feel that liquidity in the system or excess liquidity in the system could upset their inflation calculations. This was also done to take away liquidity which was generated by recall of rupees 2000 rupee notes. As we may know that the RBI announced the recall of 2000 notes in May, and as per the latest data from RBI, almost 93% of 2000 rupee notes have been deposited in banks. So that creates a liquidity which RBI is trying to absorb through this incremental CRR increase. This incremental CRR increase is supposed to end on 8th of September, just in front of the advance tax outflows. So the liquidity mismatch during that period should not impact markets. Overall, inflation is expected to go down in the next few readings, and it may go below 5% in the third quarter of FY24. Coming to rate markets, yes, markets have been as volatile as overseas. Typically, rate markets had followed cues from overseas markets. After a surprise pause in April, there was a good rally on rates, and we saw 10-year yield drop from about 7.4 to around 695, that is below 7%. Unfortunately, during this period, when the narrative changed from higher to longer rates, the 10-year has reversed some of the gains which were made in the first quarter. The 10-year is now in a 710 to 720 band and expected to remain there, as we do not see any rate easing moves from RBI in the near term. Obviously, the first step in rate easing cycle would be RBI to go to neutral on the stance. If you go back, RBI has been on the stance of removing accommodation for last three policies in spite of going into the rate pause mode. They want to retain the flexibility to move either direction if incoming data demands. That is the reason, which is similar to what the global central banks are also doing. They are becoming data dependent and are not giving any forward guidance when or where they are going to either cut rates, increase rates, or do anything else. Since the situation globally as well as locally remains very volatile and markets remain volatile, central banks have gone into the wait and watch mode for the rest of the year. We expect the same from RBI. I think that things may improve a little in the second half of the year, probably near November, December. I think that time inflation may be a little lower, and it may give little comfort to RBI to start looking at steps to ease rates. But probably the first step, as I already told, is changing the stance. It will also depend on the US stance, whether they are on the pause mode or a few more rate hikes are in the offing. To that extent, RBI may continue to remain on a wait and watch mode. From a market perspective, I feel that rate markets will be in a narrow zone. We haven't seen any sharp uptick in rates simply because supply demand are evenly matched. There is no excess supply and demand remains robust in the bond markets. The government also has done its bit by reducing the fiscal deficit year on year from 6.4 to 5.9% for this year as projected. And this has itself helped the markets to continue with the kind of cautiously optimistic stance as supply of government bonds does not increase very drastically. Overall, bond markets likely to continue in a kind of trading zone. We don't anticipate any sharp rallies in the market in the near term. On the other side, we also don't expect any sharp increase in yields as globally we are nearing the end of the rate hike cycle. Locally, RBI is in a pause mode and there is no reason for RBI to again look for a rate hike. Inflation will likely come down in near term. Government has taken steps to manage food inflation and RBI is also watching closely how things are panning out. So there is, I see no reason for RBI too much hawkish in the policy, though they will remain watchful of the inflation target as the governor and policymakers have generally told in public that the 4% inflation target for medium term remains sacrosanct and they would like to see inflation trend towards those targets. So we don't anticipate any rate action probably till again first quarter of next year, which is FY25. So for next 6 months, I would say markets will remain in a kind of narrow band with intermittent rallies depending on global cues. So what does all this mean for the investor? It is difficult to take a call, especially when rates are range bound. From a point of view of any further rate increases from RBI, we do not see that as a big probability. It's a very small event, probability event. Investors can consider over a next 6 to 8 months in a staggered manner to take advantage of slightly higher rates which are available right now. The curve is practically flat, so investors can consider in short duration funds or medium duration funds or even long duration funds. We should see some rate easing happening in the next 12 months to 18 months. And that should give investors some mark-to-market gains over 1 to 2 years. From that perspective, investors can consider in debt funds. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.